How do you know when markets have bottomed? And what if you get it wrong, buy into the pullback and markets fall further? My name's Jessica Amir, market strategist here with Mumu. It's great to have your company for the weekly where we take a deeper dive into markets and everything you need to know. So let's cover the basics. There are a few simple indications to identify a potential market bottom. Let's just go over those so you can apply them to any stock or market. Firstly, we need to see prices simply stop falling. Now, this is a simple, telling sign that usually triggers mass buying. And we usually see mass buying really start to kick in and drive markets higher after panic selling has died off. Now, let's think about where we are. The Nasdaq 100 has fallen heavily from its record all-time high. The Nasdaq 100 specifically is down 10%. Basically means we're in a correction. So we've fallen 10% from that record all-time high that we hit about a month ago. So we want to look for signs that the market's day-to-day moves are positive and suggesting that the rally up off the low can continue. Now, a great way to track this is by using candlesticks. Candlesticks simply indicate the day-to-day movements of a market or a stock. Really simple to see that a positive move in a stock is a green candle, a negative or a down day is a red candle. Basically, we want to see upward movement in a market or stock, more green candles than red. And that might suggest buying momentum is picking up. But staying on price, we want to see this term called broad momentum starting to pull the market in the right direction. Now, a way to see that is by using a technical indicator that's really popular on Wall Street called moving average convergence divergence. Sounds complicated, it's not really. Just simply tells us that the moving average of the market is pointing higher. And as the name suggests, if a moving average of a market is higher, it suggests that might pull the market higher vis-a-vis a bottoms in. Now, you can track MACDs on a stock or a market such as the Nasdaq 100 or the S&P 500 or the Aussie share market, or even on your favorite stock. Now, simply go to Mumu's charting software and type in indicator by selecting the indicator tab on our charting software, and then simply search MACD. Now, critically, when we see the MACD line cross above the key level, it's called a signal line. It basically is signified by the 0. So once we see the technical indicator called the MACD down the bottom of the screen here, which we're selecting, we've really honed in on it and it's circled in orange. Once we see that indicator cross that signal line, again, the indication of 0, suggesting the market is breaking even theoretically, that, ladies and gentlemen, inspires algorithmic or quantitative buying. Basically, all you need to know is that's usually when institutions are forced to buy. So their programs, their algorithmic models, as the name suggests, by algo traders, that's usually when their quantitative books suggest to buy into markets. So as we can see by looking at what we've displayed, the Nasdaq 100's technical indicator, the MACD, is not there yet, suggesting we haven't really seen strong momentum, but do keep your eye on this indicator. The second indicator that you want to also consider that we may have bottomed is that fear and panic is falling. Now, obviously, as this suggests, it's only at this point when we see fear and panic falling that we see a rebound. And that's typically what has happened throughout history. After fear and panic subsides, markets are theoretically waved through to move to higher levels. Now, you can track this again on Mumu's platform just by typing in VIX, VIX, that tracks the volatility or fear index. Now we know that we're displaying right here, we can see that market fear spiked this year, or earlier this year, not long ago, just a month ago. It hit its highest level in 2025, a level of 27, was actually on March 10. Now, since that day, ladies and gentlemen, the NASDAQ 100 has started to rise. And just to go back on that point there, when fear falls, markets rise. So you want to see consistency in this. Now, the concern is, yes, as we can see toward the right-hand side, that the concern is that fear is starting to rise again. If fear rises back over 20, that's usually when we see markets fall. But what we want to look for is for fear, that fear level, the VIX, what we've displayed on the screen, we want to see that fall back under 20 or even closer to 15. Perhaps I'd encourage you to think about tracking the VIX on Moomoo. The last time the volatility index fell to a level of 16, that's when markets started to recover. So please track VIX. I encourage you to add that into something that you do, perhaps your modus operandi when you're trading or investing. Check the VIX. Another validation that markets have bottomed is a simple one. We need to see that bad news is being ignored and that high-risk stocks, think about those tech stocks, that they are hitting higher levels. So what does this mean, putting it into context? Well, maybe we see bad economic news or more tariffs announced. We see that ignored. And then the NASDAQ 100 companies, the tech stocks, they continue to rebound and move up, making higher levels. Now, this could happen, right? Remembering that the market is forward-looking. They're focused on the future and what's coming over the next 6 months. So we need to see these three scenarios really start to work together before we see markets sensibly and, I guess, materially stay higher for longer. And then again, for that dip buying rationale to be brought into play. But ladies and gentlemen, I just wanted you to pause on this scenario now. What happens if you do buy the dip and get it wrong? Let's say that you're a firm believer in AI. You believe, like me and like many fund managers, that AI is the biggest growth sector of our generation. And if we think about stocks that have been hit the hardest this year, now they're looking pretty cheap. So you might be thinking that now is the time to buy the dip. But history shows us that even if we get it wrong and we buy into the dip, if we take a patient long-term view and markets still fall lower, it might feel pretty scary at the time because we might look at our portfolios and see that our market or our holdings are down 20%. It can be pretty scary, but again, if we take a long-term view, there's a lot to be said about buying the dip because we often know that fortune favors the brave. And I just want to pause on the scenario of NVIDIA back in the first trade war induced by Trump in 2018. It's very similar to what we're seeing now. Ladies and gentlemen, we saw NVIDIA shares fall 57%. From that record all-time high that we're displaying on the screen down to a brand new record low. But what if you bought halfway to that pullback and your friends and family were kicking you in the backyard barbecue and saying, mate, this stock's going lower. What did you do? Well, if you stayed the course and you were patient and you held NVIDIA for 5 years, you would have made 1,030%. If you invested $10,000 halfway into that pullback, as we can see on the screen, you would have now had $103,000. Basically, it shows you that you can be strongly rewarded even when you buy the dip and markets continue to fall. But those who pay the price, perhaps they learned that quality companies historically have always recovered from a market crash. And of course, we know when we think about the NASDAQ 100 and the S&P 500 and the Aussie share markets ASX 200, all three of those key indices have also always recovered from a market crash. Thanks so much for your company from everyone here at Moomoo. Stay safe, happy trading. We'll see you very soon.